If you can't afford a 30-year mortgage, you definitely can't afford a 50-year mortgage. Welcome to the Overnight Edge. In this episode, we're going to be discussing the 50-year mortgage, its pros and cons. You may notice that pros is in a very small font, and there is a reason for that, which you will find out shortly. But first, let's discuss the 50-year mortgage and why it's in the news today. Well, it is currently illegal to sell a 50-year mortgage. This is because of the Dodd-Frank Consumer Protection Act of 2010, which followed the 2007 subprime mortgage meltdown. If you were around then, it was quite the mess. It was the biggest housing crisis we've ever had in the United States. I kind of became a tax foreclosure expert during the time, so I know a lot about it. I lived through it, and I was also teaching economics at the time. It was wild. So, as a result, only 30-year mortgages or fewer years are basically legal, and that means they are the only ones that can receive protections for the mortgage companies for unfair lending practices. So how to get in the news today? Well, Bill Pulte, he is both the Fed Housing Finance Agency Director and also the grandson of the founder of Pulte Homes, which was founded in the 1950s. Have you heard of him? His granddad founded that company. He mentioned the 50-year mortgage in a tweet, I believe, and then President Trump mentioned it also out loud at some point somewhere, and the world just went nuts. So that's why we're discussing it today. So what is a 50-year mortgage, you may be asking? This is a pretty basic question. It's a reasonable question. What's the answer? It's just a regular mortgage. Take your 30-year mortgage, 15-year mortgage, whatever your mortgage is, spread it out over 600 payments, and you got a 50-year mortgage. So you're paying that mortgage over 50 years. How does this compare to a 30-year mortgage? Well, let's use an example. Let's say Jack and Jill want to buy a $370,000 home. This happens to be the median value currently on Zillow of home values in the United States. So we went with $370,000. And a lot of people believe you need 20% down. Most banks will tell you that. In reality, however, first-timers generally pay about 10%. There's all kinds of programs you can get, kind of like happened in the 2007 area, just so you know. Era, I should say. Anyways, we're going to 20%. That'd be $74,000. Well, there's a big reason people can't afford a house, isn't it? $74,000 for a down payment. You got a car payment, you got student loan payments. That's kind of a lot of the problem. But you got all that, how are you going to save up $74,000 if you're just a newly married couple for a down payment? But I digress. So they come up with the money, so they have to finance $296,000, and they're going to have an interest rate of 6.33%, which is basically the market as of today, as I'm recording this. That is your average mortgage rate in the United States currently. So what's the payment on the 30-year? Payment on the 30 year is going to be $1,837.95. What about the 50-year? You will notice it's a little less. You're spreading those payments over a longer time. $1,630.82. But here's what a lot of people forget when they are thinking about how affordable a mortgage may be. They forget about the escrow items. Most of these items are generally paid through your mortgage payment. Property taxes on this house, average in the United States right now, based on the $370,000, is going to be $2,900 a year. That's $241.67 a month. And then, of course, you got to insure that puppy. So you got another $1,750 equals $145.83 per month. So your total escrow payment for Jack and Jill is going to be $387.50. So the total payment, 30-year mortgage, $2,225.45 per month. 50-year mortgage, $2,018.32 per month. Monthly cash savings, $207.13. Wow. That's $2,485.56 per year they can save by you doing the 50-year mortgage. However, listen to me. What's the real cost? Let's think about it. 30-year mortgage, total interest paid on that mortgage, a 30-year mortgage of 6.33%, $366,108. Wow. You're pretty much paying twice for that house. What about the 50-year? Watch. $80,764 in interest. That's $314,656 more that you're going to pay. So you're almost going to buy that house 3 times by switching from a 30-year to a 50-year mortgage. Now, what's this in real terms? That's a lot of money you're going to be paying for 50 years. So let's take this here. That's 20 extra years. That's 240 extra payments. The extra payments basically equal $1,311 per month. What if you took that money during that 20-year period and invested it? What would you come up with? At 6.5% reasonable rates for the market over a 20-year period, you would have basically a nice retirement nest egg, $642,941 just by investing that 20 years of payments. I got to tell you, that's crazy. Folks, if you do this, it's kind of like the car payment. I got to tell you that too. Most folks have a car payment. You're trading your retirement for a car payment. You're trading your retirement for a 50-year mortgage. That's the real cost. So what's the pros and cons? Well, you're getting a slightly lower payment at a giant cost. Basically buying the house a third time, almost. So the bottom line, what's the bottom line here? If you can't afford a 30-year mortgage, you definitely can't afford a 50-year mortgage. Keep that in mind. You hear about them. If they actually do it, run from them. Please run. Don't walk. Run. Run screaming. Don't do it. All right. Overnight Edge. Are you dealing with your own housing crisis? Leave a comment. Let us know. Might have a great idea for an edge. Maybe we can discuss it a little bit. Maybe steer you in the right way. I don't know. We'll see what happens. Also, check out the playlist for more great tax and business tips. Also, if you want to dig deep, if you really want to learn something that'll help your business grow, cut your taxes, check out our courses on overnightaccountant.com.